As a beginner investor, we are bombarded with countless of information about the stock market, how it works, different strategies, do's and don'ts, so on and so forth. With all this, it gets harder for us to process what's really needed and what is just noise. And sometimes, we complicate investing so much that we are actually creating more damage than good. So why am I saying this? And how does this relate to building up a good dividend portfolio? Well, dividend investing is a long-term strategy. And for me, in order for you to maintain it properly, you need to make your life easier. You need to use a strategy that you can maintain for a very long time. And for you to do this, it doesn't take you a lot of brain power to do so. You don't need those complicated charts and hear all those analysts forecast day to day. You just need to stick with the basics and do it for a long time. So this is what this video is all about. An easy way to create a good dividend portfolio. But let me just remind you, if you think dividend investing will make you rich quickly, no, dividend investing takes time to work. You need to let it snowball for a very long time. Your horizon should be 20 years or more, and I tell you, it will all be worth it. Just think of how you can retire comfortably in the future, even without doing anything. You are earning money while you sleep, which is the best way to make you rich. As Warren Buffett said, if you don't find a way to make money while you sleep, you will work until you die. So dividend investing is a great way to let your money work for you, earning money without a need of your presence, and the maintenance for it is easy enough so you can stay consistent. But of course, we need to know how to build one properly. So the first thing we need to take note of is, invest only the money you're sure you won't be needing for the next 10 or 20 years. Now hear what I have to say first, and don't just skip this. This is the simplest way to start building up your portfolio. Assess your financial standing first. How much money you can invest that you're sure you won't be touching. Because as I said earlier, dividend investing takes time to work. You need to let your money compound for a long time, to let it grow to an extent that you can retire off of it. So how can you do that if 2 or 3 years from now, you will be withdrawing again and again from your account? What's the point of knowing all the complicated ways to analyze stocks if you can't even keep the money in your account? Assessing yourself is the most skipped step, but it is the most crucial one. So if you don't know where to start, build an emergency fund first before even opening a brokerage account. About 3 to 6 months worth of expenses. This way, if the rainy days come, then you're sure you won't be touching your investment. But if you're so eager to start investing right now, then do what I did. Take a percentage of your income, then 50% of it goes to building up your emergency fund, then 50% goes to investing. Then once you fill up your emergency fund, go full on investing. If you don't know what percentage of your income you would use, then use the 10% rule. Take off 10% as soon as you get your salary, then the remaining money you have, that's what you use for your daily spending. If it's not enough, then adjust your lifestyle. Don't ever touch that 10%. As soon as you get into the habit of saving, then I think you'll save more the next year. And the more you can save, the more you can invest and grow your dividend portfolio. So don't underestimate this part. Developing this habit will surely benefit your investing journey, and this will help you go for the long run. Long-term investing is a proven strategy, and for you to stay in the game, you need to develop this habit now. So now that you have engraved in your mind to be a long-term thinker, you need to know where to put your money, and the first rule you have to follow is to invest only in what you know and understand. Do not invest in a company because you just heard it from a friend or a YouTuber, or invest because it's a popular stock. Chances are, if you do this, you will surely lose a lot of money in the end. Yes, you may be lucky sometimes, but this wouldn't be a good long-term strategy. Warren Buffett has a term for this, investing in your circle of competence. By investing only in the companies you know and understand, already helps you filter out stocks and also helps you take out the noise you hear. If you research first before pressing the buy button, you will know if the company is a good investment or not. If you see the company isn't doing well or has bad management and financials, then just throw the idea of investing it in the trash, then move to the next company. This is what I mean by how this filter out the noise. If you're tempted to buy the company because this is a hot stock, then try looking into the company first. If it passes your checklist, then that's the only time you will buy it. Knowing and understanding the company you buy helps as well in keeping you calm, which in turn lets you survive for the long run. Just look at it this way. What if you invested solely because it was a popular stock, then the stock price plummeted? Surely you will panic because you don't know anything about it. compared to someone who knows well the company he or she invested in. Because even if the stock price drops, if you know it's a strong company that has good financials and leaders, then instead of panicking, you would even be happy and buy more of it. This alone is the biggest difference between a speculator and an investor who truly knows the company he is invested in. So speaking of financials, that is the third thing you need to know for you to build a good dividend portfolio. You need to invest in companies that have strong financials. Some dividend investors make the biggest mistake of investing only in companies that have high dividend yield. But what they don't know is, dividend yield can be a trap. Just imagine this. How can a company pay consistently their shareholders if they don't earn anything? Well, some companies use debt to pay dividends, which for sure they won't be able to maintain for a long time, which compromises our long-term strategy. So, 1. Check if the earnings of the company are growing every year. With a company growing its earnings yearly, there is a high chance that a company will also increase its dividends, since dividends rely on how much the company earned. 2nd, check if the company's equity is growing steadily over the years. This shows that the company is gaining more assets than its liabilities. And speaking of liabilities, check as well if the company is managing its debts. This is easy enough. You can check the current ratio or debt to equity ratio. We want a company that manages its debts well, because debt can be a killer of companies. And if it has a large debt, this can hinder its growth in the future and may even lead to the company cutting its dividends, which we don't want as a dividend investor. And as I said earlier, dividend yield can be a trap. The company may be paying too much of its earnings, leaving little money left for the company to grow. So check their payout ratio as well. We don't want a very high payout ratio. Usually what I look for is a payout ratio not greater than 60%. But of course, some investments like REITs are an exemption, since they are obliged to pay most of their earnings to their shareholders. Now, there are a lot of free websites out there that can help you do this, like MSN Money, which shows you 8 years worth of data of the company's earnings, equity, and cash flows. Though it isn't complete, you can complement this using another website like investing.com, which shows a much better view of the financial statements, though they only show 4 years worth of data. And speaking of other websites, one such is simply Wall Street. All that I talked about of knowing and understanding the company first is simplified using this. They give you research on countless of companies worldwide. They give you different data about the company, from price valuations, future growth, past performance, financial health, management, dividends, and a lot more. They also give you a heads up on what's happening to the companies in your watch list, from earnings release, insider buying, and dividend announcements. And they also give you their intrinsic value computation, which we will be discussing later on. This will surely help you keep track of your stocks, and the best part of it, they also have a portfolio tracker, which lets you assess the health of your portfolio. How convenient is that? And it's all in one platform. So sign up now using my link below. They offer a forever free usage of their basic plan, and by signing up using my link, you get a 14-day free trial of all their platform's features. And not only that, if you do avail their plan using my link, you get a 30% discount. What are you waiting for? Level up your investing journey with Simply Wall Street. Anyway, those are an example of websites that you can use to analyze a company's financials. These are just the basics of what you need to look at to filter out companies that are good addition to your dividend portfolio. The next thing you need to take note of is having a computed intrinsic value and a margin of safety. This is what price you're willing to buy the company for, or what I call my buy below price. So when a company's stock price falls down your computed buy price, then that's the only time you will buy it. Because even though we are dividend investors, of course, we also want to gain money from capital gains. And although we know the companies we will be investing in are strong because they pass our checklist, still we need to buy at a good price. Now, there are countless of ways to compute a company's intrinsic value, but what I usually use is the EPS formula, as I want to call it. By the way, I won't be diving into creating this Excel sheet. Since I already have an old video for this, I suggest you watch it after this video, link down below. This approach projects the future earnings of the company, and the best part of it is very easy to do. First, I need to get the EPS or earnings per share, which is available on every free platform, though the hard part is the 5-year price to earnings high and low. Now, there are paid websites out there that have this, but if you don't have one, if your broker provides financial data, some have a history of its price to earnings ratio, so just get the lowest and highest year, though this may not be as accurate. By the way, this is from Mercantile Securities. If you don't have yet a Philippine broker, then this is a good choice for you, especially if you're a long-term investor. They provide research data which will help in analyzing companies, so use my link down below to open an account. Now another way is using Investogram's chart. They have an indicator that shows the PE history. Just get the highest and the lowest from the past 5 years. Anyway, once I have my 5-year high and low PE ratio, I will now get their growth rate. Back then, I usually used the ROE as my percentage, but since I am projecting earnings growth, then might as well use their past 10 years average earnings growth. But if you don't have 10 years worth of data, then 8 years from MSN Money is still okay. Once you collected all the data, you can compute for their 10 years average growth rate. What I usually use is their compounded growth rate. Let's put Costco Capitals for example. The current EPS is 1.01, with a 5-year high of 11 and a low of 3, getting the average PE of 7. With a growth rate of 11%, we get a future value of 20. The future value is a projected value of the company 10 years from now, so we need to get the present value or the intrinsic value, which is 7.74. Now if you notice, the buy price is lower than the intrinsic value because there's a 30% margin of safety. So why is that? Well, what we are doing isn't an exact science. We are merely projecting or assuming the company will grow at a rate of 11% for the next 10 years, and there may be some errors in our calculation as well. So this is the purpose of putting a margin of safety to allow some cushion, as you may say, from some errors in our calculation. Putting a margin of safety is very important and is a must when computing your buy price. Warren Buffett and Charlie Munger easily explained this in their statement. Warren said, "You don't drive a truck that weighs 9,000 pounds across a bridge that says limit 10,000 pounds because you can't be that sure about it." And Charlie Munger emphasized why people buy an overly priced company, creating a bubble. In engineering, people have a big margin of safety, but in the financial world, people don't give a damn about safety. They let it balloon and balloon and balloon. It's aided by false accounting. So every time you compute for the intrinsic value, always put a margin of safety. What I use is a 30% off for my computed intrinsic value. Another thing to take note on is never use a very high growth rate. Some investors do that. They project earnings growth at a very high percentage, which is almost impossible for the company to do. Always be realistic with your growth rate. Now, if you don't want to do all this work, simply Wall Street has its own computation or their fair value. Now, what I do for this is still take 30% off from their computation to still have a margin of safety. The next step to building a good dividend portfolio is proper diversification. The meaning of proper is you diversify your investments over different companies and in different industries while still following the previous things that I've said. Meaning, you're still buying companies in your circle of competence, has good financials, and are trading under your buy below price. You aren't just diversifying for the sake of diversification, which some investors do. They buy different companies they have little to no knowledge of just for the sake of spreading their risks. No, it still has to pass your checklist. And there's another one, which is to diversify across time, meaning you invest consistently every month or year for a long period. What I do is the value cost averaging approach. When companies on my watch list are trading under my buy below price, I invest consistently every month in it. Buying at different time frames already solves the problem of trying to time the market. So the main key takeaway here is diversify over different companies, spread throughout different industries to minimize risk whenever one industry falls down. Your other investments located in different industries would still give you a good amount of dividends while you're waiting for that industry to recover. Next, diversify properly by following your checklist and diversify across time. This is to maximize diversification. So with that, this ends this video for today. Remember these basic principles. First, invest some money you won't be using for the next 10 to 20 years. Second, invest in your circle of competence. Third, buy companies that have good financials. Fourth, have a computed intrinsic value and a margin of safety. Lastly, proper diversification. By following these rules, it can help you build a good dividend portfolio. But of course, these are just some quick rules. You can add on as much as you want, as long as you can maintain it well for a long period. So before you leave, I hope you click the like button first, and if still aren't subscribed yet, do help the channel by clicking that as well. And if you aren't subscribed to Simply Wall Street, then try it now. There's nothing to lose. So thank you and see you in the next video.